Why is Red Lobster closing restaurants? Hello and welcome to The Week in Restaurants, a look at the most important stories of the week in the restaurant industry. I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and I am here with Senior Tech Editor Joe Guszkowski. McDonald's reported earnings this week, and I'll talk about everything associated with that. Red Lobster may be closing more restaurants. We'll discuss whether that's a good idea or not. Later on in Tech Check, Joe, what are you talking about on Tech Check?
I'm talking about delivery and why it's not going away.
Oh, all right. Fantastic. But first, Joe, have you heard of Fat Brands?
No. That's a funny name. Who's that?
That is the operator of several restaurant chains, including Twin Peaks, Fazoli's, Round Table Pizza. Round Table Pizza, by the way, the second largest chain in the Fat Brands universe, but nobody ever really talks about it because it's just in California and out west. Anyway, they're bankrupt.
Yeah.
And you might have heard about that or once or twice. Frankly, we'll probably talk about Fat Brands a lot over the next couple of months. That bankruptcy is very complicated and things keep coming up. Most notably, the issue that has come up recently is the management actions of the CEO and founder of the company, Andy Wiederhorn. So what happened late last week, a group of the company's lenders or bondholders essentially made a push to get him out of there, to suspend him at least temporarily over a stock sale involving Twin Peaks. After the bankruptcy. So in a bankruptcy filing, once you file for bankruptcy, your business, anything you do that is outside of what is called the normal course business, in other words, paying employees, selling food to consumers, buying beverages from Pepsi or Coke or whatever, but anything other than that, you have to seek court approval. So if you do something that isn't, like if you close a restaurant, if you, I suppose, open a new restaurant, things of that nature, you actually have to seek bankruptcy court approval to get that. And that stock sale was done just a couple of days after the company filed for bankruptcy and was done without court approval. They asked for approval after the fact. Essentially, once the lawyers found out about things, the lawyers probably freaked out and then immediately sought court approval. The lenders and Fat Brands do not have a great relationship at this point. I think that is fair to say. They are in mediation. They've been in negotiation for months over the debt situation. Fat Brands has $1.5 billion in debt, an enormous amount of debt. A few interesting things about that. Shortly after the bankruptcy was filed, that those same lenders had tried to get a trustee appointed to oversee the brand. They do not trust Andy Wiederhorn at all. And the comments that have been made about his management regarding they don't trust what he's going to do, they are concerned about what he is going to do while still operating the company. They have put various rules and setups in place to essentially operate as a check on Andy Wiederhorn to make sure that he is doing things the sort of right way and is not selling stock without court approval, things of that ilk. So, I mean, the thing is, the other thing I'll point out is what the lenders have been accusing Wiederhorn of doing. And I will get to what they had said most recently because it is actually really fascinating. He has been paid a lot of money over the last couple of years. This is according to a court filing early, and all of this is well known. So there was this situation. The Wiederhorns got in trouble over a $47 million forgiven loan from Fat Brands. Fat Brands essentially loaned the family $47 million and then forgave it. That is why he got into trouble with the IRS in the first place. If you remember, he was charged with various federal tax charges. Those charges were dismissed once the administrations changed. He has admitted apparently in documents that he did accept that loan and it was forgiven. There's $22 million in salaries, benefits, consulting fees paid to Wiederhorn and his family. That includes $1.1 million in retention bonuses and pay increases that were awarded shortly before the bankruptcy was filed. The Wiederhorns received $17 million in dividends from the company over the past 5 years. Between 2017 and 2021, they received $27 million were spent on private jets, vacations, jewelry, and other personal expenses. And then there's this last one, and there was what they're saying, and they're making an accusation is a material portion of $85.5 million in litigation expenses were paid this is according to court filing, were paid to Wiederhorn's personal lawyers who to defend him from those various charges. That's a lot of money. Really since 2017, and much of it over the past couple of years. Anyway, the whole point of that is these issues of Andy Wiederhorn and his operations, they accused him of operating Fad Brands like a personal piggy bank. That term has been bandied out before. He's faced a number of lawsuits and things of that nature. So Andy's managed now. He's managed to survive because of the systems put in place to act as a checks and balances. But I've rarely been privy to the sort of commentary that we'd heard from lenders about an executive like that. So we'll see. Probably will not be the last time we talk about the Fad Brands bankruptcy between now and the next several months.
I think we said that last week.
Yeah, well, we did say it the last time that we were talking on this particular podcast. So, we'll see. It's a big, complicated bankruptcy, and one that we're, we'll see what happens. I would suspect, by the way, that Andy's wants to buy the company. He has indicated an interest in bidding. There is some concern about conflict of interest there. That's common, by the way. Where management teams or even prior owners want to buy the company out of bankruptcy after the loans are taken care of. That's not uncommon, actually. But there are concerns about conflicts of interest there, and things of that nature. My guess is that the company probably ends up getting broken up, and then Wiederhorn will end up with a smaller number of brands. We'll see what happens with that. So, speaking of companies that have a bankruptcy in their recent history, what's going on with Red Lobster?
Yeah, so Red Lobster, the CEO, Damola Adamolican, spoke with the Wall Street Journal this week and sort of gave an update on the company, which is about a year and a half out of bankruptcy. And one of the things he said was they're probably going to have to close more restaurants. And they've already closed a lot. They closed during the bankruptcy year of 2024, they closed about 130 locations, which is about 1 out of every 5 of their locations. And it sounds like they want to close more, potentially dozens more. And these would be, underperforming locations. And they also may be locations that have very high rent. And if you recall, one of the reasons for Red Lobster's bankruptcy was that when it was acquired by Golden Gate Capital in 2014, Golden Gate sold all of Red Lobster's real estate for $1.5 billion to finance the deal, and that saddled Red Lobster with all these really bad leases. And so that issue, I think, continues to be a problem for them. And they're looking at closing some of those restaurants that are not performing well, but also just can't afford the rent. That said, there are some bright spots, I think, for Red Lobster as it kind of bounces back here. Sales have improved, he said. I think he said they're up 10%, but still not to pre-bankruptcy levels. But they've worked on bringing people back into the restaurants. They kind of updated their marketing. They did these really popular seafood boils that are now permanently on the menu. It sounds like there's still more work to do in terms of sort of renovating the restaurants and upgrading the interiors, refreshing them. they've also cut costs, and they've laid off managers from the restaurants. They've cut corporate staff. So you take this all together, and you see that I think this Red Lobster turnaround, if that's what we're going to call it, is going to take some time. And the CEO Demola even said this was a very damaged brand when he inherited it out of the bankruptcy, and so he's kind of in charge of cleaning up a lot of this mess. And it's been a mixed bag, is kind of what I took away from that story and some of the reporting we've done. Customers are interested. I think Red Lobster is sort of back in the zeitgeist a little bit, but it was really burdened by a lot of problems going into that bankruptcy.
Yeah, that's I don't know where to start, man. Let me say this. So I pulled up some numbers on Red Lobster from our friends at Technomic. Their system sales over the past, this is again through the end of 24, so we don't have 25 data yet. Their system sales down by a third over 5 years. Their unit count is down by almost 24%. Average unit volumes down by 22%. The sale leaseback that was done a decade ago when Red Lobster was sold was one of the more egregious things that I've seen, and this was all predictable. It was absolutely predictable. And look, I'm not anti sale leaseback, where you sell real estate and then you lease it back. It is a good and decent form of financing as long as you're careful with it. It's like any other form of financing or debt or whatever you want to call it. As long as you don't put too much of a burden on your company over the long term, you should be okay. But the deal was very favorable, even at the time. Again, we could see it. I looked at it at the time. It was very favorable for the lenders. And, the brand under Golden Gate operated perfectly fine for years. They had a really good CEO in Kim Loptrup. So it wasn't as if it was an immediate damage to the company. But, when you are, especially with sale leasebacks, if you're going to do that sort of thing, you are putting some pressure on your future company years down the line. And this is essentially what Red Lobster is having to deal with. They, you have a, and the other issues notwithstanding, the all you can eat shrimp deal, the way the pandemic, et cetera, et cetera, et cetera, those issues happen all the time. No. Okay. So first off, we usually don't see a supplier buying a restaurant chain and then directing its entire supply chain to itself. That was a little unusual, but we do see events. Anybody who's operated a restaurant for however long knows that things happen. Things happen to the restaurant company. The restaurant, there's recessions. We've had, since we've had, just in the time that I've covered the business, we have had 2 major recessions, and I don't know how many damn black swan events. These things happen. And if you want your brand to survive over the long term and be more valuable, you make sure that you don't put up too much debt, too many onerous leases, et cetera, et cetera. Don't put your company behind the 8 ball before, don't put your company behind the 8 ball with your financing decisions. It's not rocket surgery. This ain't hard. And that's essentially what he's having to deal with. They're coming off, a brand coming off 10% increase in sales like that should not be saying, well, we're going to have to close restaurants again. That's, that should have been done in bankruptcy. But that is sort of the reality that Red Lobster's in. But good. All that kind of attention was really good for him, and I can imagine that would be very beneficial for him.
Yeah.
So, let me tell you about McDonald's. Have you heard of them?
McDonald's, I have heard of McDonald's.
All right, really good.
Yeah.
So they had earnings yesterday. They had their best sales result in more than 2 years on a 1-year basis. On a 2-year basis, it was a significant acceleration. So their same-store sales were up 6.8%. We obviously don't have, we have Burger King's numbers, and Burger King was saying this morning that they outpaced the QSR environment with their 2.6% same store sales in the fourth quarter. So you can probably do the math and expect some weak sales results out of some of these other chains that you have yet to report. But McDonald's hadn't done 6.8 since 2023. They did very well with essentially three things. Number one, according to McDonald's, their argument is that extra value meals, their lower prices on extra value meals work really well, and improve cash flow for franchisees. But they really had two really strong marketing promotions. They brought back Monopoly, which us old people are familiar with. From back in the day, they brought back Monopoly. It led to a very big spike in loyalty signups. They now have 210 million global members of their loyalty program, which is substantial, and generate $37 billion in sales from that group last year alone. That's globally, not just in the US. Really strong performance on the loyalty program, but the Monopoly thing worked really well. And then they did the Grinch meal in December, which was insane. They had their highest sales day in McDonald's history when they introduced that. For 1 week worldwide, they were the biggest seller of socks in the world for a week. They sold more Grinch meals than they sold collector's cups and Minecraft movie meals, both of which did very, very well for the chain the last 2 years, more than those two combined. Suffice it to say, Joe, they're not going to do as well in the first quarter of this year because they don't have anything quite like that. But they did give away free caviar kits, and those sold out in a matter of minutes. And I found one for $5,000 on eBay. I probably don't rush out to get restaurant stuff nearly enough and then sell it on eBay. Apparently, can make a massive profit. But yeah, really good quarter for them after a couple of years. We've seen a couple of restaurant chains seem to get some recovery towards the end of last year. You got McDonald's, Starbucks. Last quarter, it was their fiscal first. But the last 3 months of last year, really, really well, really strong for them. So, you do see some chains and turnarounds that did relatively well towards the end of last year. Now, coming this year, McDonald's going to introduce a much bigger beverage lineup. They are testing improved quality in a number of areas. So lots of stuff coming up from them.
Yeah, it's interesting. I didn't listen to the call, you did, but it sounds like they really are pushing the value narrative, and that consumers are loving the value they can get at McDonald's. But then they sell all these Grinch meals that, I was looking at the prices. Those are not value meals. Those are not cheap. So maybe it's a little of both, but I don't know. Is it the value that they're winning with, or is it these really cool promotions that only a really big brand like McDonald's can do?
My theory on this is that right now we have essentially a bifurcated economy. We have lower income consumers are not eating out as often as they used to. And for much of the restaurant, especially for the fast food business, for the pizza sector, for the burger sector, for you name it, that lower income consumer, if they start, I mean, that's half of the country, by the way. It's not insignificant. Half of the country is not doing well at all. And inflation's hurt them hard. Younger consumers hurt them hard. That is something that Chipotle talked about a lot last year, is that younger and poorer consumers are just not eating out as much. And it's kind of a foundational piece for much of the fast food business. And when that group is cutting back, they are difficult to get into the restaurants. But the rest of the consumer base is doing enormously well and are fine. Stock market is great. The labor market still seems to be relatively healthy, especially if you work in healthcare. There are a lot of things going really well. For people who have a little bit of money are spending it and they're buying stuff. And I was at a Technomic event not that long ago, and they had an economist talking about it, and he mentioned that if one higher income person just takes an extra $10,000 vacation, that essentially equals the total spending for 20 people who cut back $500. And the restaurant industry needs a lot of people to be eating out to be able to have a broad growth in the industry. You're going to have you're going to have share trading going on. It happens all the time. But for the restaurant industry to increase, and especially for the fast food market to increase, they need people eating out because it's a saturated market. And so my theory is that what we see right now is a social media generated. Social media is a big deal on a lot of fronts, and it is. And this is what Chili's discovered. Chili's kind of figure out, hey, if we concentrate a lot of our efforts on social media, they do a lot of other advertising, but if they have used social media very, very effectively to get customers in the door, and it's worked out really very, very well, and it leads to extreme sales results. And so McDonald's sent out its Grinch socks, and that was a big deal for on social media. By the way, Burger King also did the SpongeBob movie menu, and that was also on fire late last year. And we've seen that. We've seen these marketing strategies work really well, even on chains that have not done well over the past couple of years. Starbucks, I mentioned Starbucks over the past 2 years. They've done like their holiday. Well, I mean, this year their holiday menu introduction with their barista cup. By the way, that they had no idea that was coming. That barista, they were not ready for it at all. I mean, now they quickly picked it up, et cetera, and there'll probably be more coming on that, I would imagine. But it was just one of the many different items they were introducing that they were selling when they introduced their holiday menu, and then people gravitated toward it, and they sold out quickly. So that hit. That was a social media thing. You have the Minecraft thing. You have Starbucks' introduction of its pumpkin spice latte in the fall hit records for the company. So we see this over and over and over again, where a company that just hits the right notes on marketing and plays well for social media just hits it. Then that's what happened, like with McDonald's. With McDonald's giving away caviar. That's why we're seeing so many crazy things. Like you just wrote about Valentine's Day, right? Seeing plenty of crazy things there, are you not?
Oh man, so it just seems to get weirder and weirder. But the big one for me was this Red Lobster partnering with Vaseline and and giving away like a little tub of Vaseline as part of their Valentine's Day meal. I mean, it's funny, but it's just like, where's this stuff coming from? But I think it's all driven by social media. They're not, they weren't even offering this meal for Valentine's Day. I think it ends today. So it's like, it's not even, it's completely detached from the actual event itself. It's like, it's just attention, eyeballs.
Right. Vaseline, nice. But we also had what was it? We have like meat rings. Was it Longhorn? The
Yeah,
Longhorn
Longhorn did
Steakhouse.
rings with meat and then
Longhorn Steakhouse. Longhorn
yeah,
Steakhouse.
Longhorn Steakhouse,
Jumped
not a
on this.
crazy wild brand
No.
that's ever does stuff like this. They're selling rings with steak in them. So
Yes.
yeah,
Yeah. And
and
then you had
physical
Dave and
objects.
Buster's. Yeah.
Physical objects. People,
Hmm.
consumers want like a little something. It's like the whole Happy Meal theory, but adults want it too.
Yeah. I mean, they do. That's called kidults. I mean, that's exactly what it is. In fact, now all this is making me, I might have to do a podcast on kidults. I did a story on it not too long ago, but that's essentially any adult that collects stuff. I obviously fit that uh, narrative with all the stuff behind me, and it works really well. And if it plays well to the social media, people are going to gravitate towards it, and that's what happened.
Mhm.
And companies are figuring it out. But yeah, I mean, meat rings, Vaseline. I mean, I I mean that's clearly social media generated. So we'll see. Well, coming up later in the podcast, Joe talks delivery and why it continues to grow despite the fact that people don't have any money. Joe, whatever. I'm not a delivery customer, and I'm too cynical for this sort of thing, but I understand why they do it. It's all because of convenience. But I'll let Joe talk about that a little bit later. But first, Spoon's going to serve you up an ad.
Restaurant operators, are you ready to lead the future of food service? Join us at the Restaurant Leadership Conference happening April 19th through 22nd, 2026 in beautiful Phoenix, Arizona. At RLC, you'll connect with the top industry leaders, gain insights from iconic speakers, and discover the strategies and tools to take your business to the next level. This year, we're celebrating 25 years of innovation and leadership, making it our biggest and best event yet. Don't just keep up with the future, lead it at RLC 2026. Learn more and register now via the link in the description.
Hello and welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, food delivery isn't going anywhere. A New York Times article about Americans' delivery habits went viral this month thanks to unbelievable anecdotes like this one. A San Diego woman who spends $200 to $300 a week, a quarter of her income, on food delivery. The reaction from many readers was, in this economy? For years now, food delivery, with its exorbitant prices and lukewarm food, has defied everything we thought we knew about consumer behavior. While restaurants, by and large, have struggled, restaurant delivery apps have soared. Uber Eats just reported one of its best quarters in recent memory. So how has delivery proven so sustainable? Delivery apps have done a great job of making themselves useful. They offer a wide and growing selection, monthly subscription plans that encourage frequent use, and a growing array of BOGOs and other deals for price-conscious customers. On top of all that, they're just really convenient. So while some consumers cringe at the thought of having their dinner delivered multiple times a week, for others it's become as natural as Netflix or Amazon Prime. Which means that for all of its flaws, delivery is definitely here to stay.
And that should do it for The Week in Restaurants, which was edited, as always, by Spoons. You can find this and other episodes of the podcast on our website at restaurantbusinessonline.com. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays for Joe Guszkowski. Thank you for listening.